Hey everybody, Scott here. Hope you're having a great day. Wanted to put this up quickly. I apologize, I'm in a t-shirt. I was diving down the rabbit hole of different housing videos on YouTube and I ran across this one that is just full of a lot of errors. I was 10 minutes through watching it and I had found 13 major issues to discuss. So rather than continue taking notes on his site and leaving comments, I decided to just do a video. So the second half of his video I will be watching with you for the first time, but the first 10 minutes I've got 13 issues that I think he is mistaken on, and I want to attribute this not to malice or intentionally trying to scare people or drive subscribers to his site, but more of a fact that he's a younger guy. He probably was not around during the last crash, or was not around as a real estate owner or investor during the last crash. So he's reading charts, reading graphs, and not understanding the dynamics behind what was driving numbers and the situations. And he's completely, I believe, misreading what's happening right now. Now, a lot of this is he's been calling for a crash for quite some time, and he's got to kind of extend that a little bit. So a lot of this also may be confirmation bias. He's looking for anything that will support his way of thinking, and he's really starting to reach. So thought it was dangerous to have this out there and have people really think it's true, so I thought I would make a video and react to it. So let's get going. Okay, so this is the video we're going to take a look at. It's why the housing market hasn't crashed yet. Is it a repeat of 2008? It's by Reventure Consulting, and let's jump into it.
We're in a very interesting time if you're a home buyer or a real estate investor right now, where the housing market is massively overvalued, home buyer demand has collapsed, but prices have remained resilient. Where you can see data from the National Association of Realtors is saying that prices are only down by 1% year over year in June 2023, similar decline to what we saw in 2006-2007 at the start of the last downturn. And what concerns me is that lots of people in today's housing market are thinking that there is no crash or that it's not going to get worse simply because it hasn't happened yet. And I would caution you guys against thinking that, because
Okay, so his first mistake he said is that housing demand has crashed. That is not the case at all. Housing demand is down. Housing supply has crashed. Now, housing supply has crashed more than demand has fallen, and we see that with still getting multiple offers on properties that are priced right, properties not staying on the market long, and inventory staying low. So just the fact that inventory is staying low belies his statement that housing demand has crashed.
right now, the housing market is massively overvalued, with home prices about 31% overvalued compared to the level of incomes in America, and 26% overvalued compared to the level of rents. And these sky-high levels of overvaluation are even worse than they were in the lead up to the last housing bubble, which suggests that massive downside still remains for home.
Okay, here's another one. One of the reasons your housing costs compared to rents are so much higher is that housing costs have gone up dramatically as interest rates have gone up. Rents have gone up, but not quite as fast. And especially if you look at the so-called blue states and blue cities, they've got massive rent control, which is keeping rents artificially low. So it may not be that housing is overvalued, but rents in some areas are being held artificially low. In terms of income levels, yes, people are putting more of their income towards housing, but realize that those people are putting that income in at a 30-year fixed loan. So somebody having trouble making it today, as we see more inflation, their job salaries are going to increase the same way inflation does, and you're going to see that monthly burden of mortgage payment have less and less of a toll over time on people.
Home prices in the U.S. housing market. However, there's an obstacle, a barrier that's keeping these price declines from occurring, and that barrier is low inventory. There simply aren't many homes for sale. With data from the National Association of Realtors showing that single-family house inventory is clocking in only around 950,000 right now, that's about 50% below the long-term historical average, and you can tell this inventory has been on a structural decline for the last 8 or so years. This low inventory is what's causing prices in America's housing market to remain resilient and even to have gone up this past spring. However, what's important for you as a home buyer to understand is that this is not a stable situation. Inventory is not low because there's strong buyer demand. Rather, inventory is low because sellers are refusing to list their homes for sale onto the U.S. housing market. With data from Redfin showing that new listings for sale are down by about 25% from their long-run historical norm. But I gotta tell you why I think inventory is going to increase on the U.S. housing market into the future and push price.
Okay, let me stop him here again. Yes, inventory is at record low levels, and has been declining for years. It's at record low levels because people in homes that have been in homes longer than a year or two have a 3% mortgage. You are not going to go from a 3% mortgage to a 7% mortgage and get anywhere near the same type of home as you're in now. Therefore, they're staying. We're seeing the length of time people stay in their homes go from 5 to 7 years to 10 to 15 years. That's not bad for neighborhoods as long as you like your neighbors. It's terrible for the real estate industry, but it's not bad for neighborhoods, and it's not bad for real estate values. There's not much on the market, so there doesn't need to be the demand that there was 10 years ago to soak up the limited supply that we do have.
Prices down. And that's because there's lots of, let's call them risky mortgages out there on the U.S. housing market right now, everyone. This is something you really have to understand about why it's a potential risky time to buy right now. It's because there's lots of homeowners in America right now that can barely afford their mortgage and property tax payments. We have lots of homeowners who are what is called house poor, who are just barely getting by on paying their mortgage. And because the unemployment rate is low and because we haven't seen the recession worsen, they're holding on. But these people are at high risk for selling into the future if the economic downturn gets worse. And one way to understand this, folks, is to look at a metric called the debt-to-income ratio for home buyers in America. This is a data point tracked by the Federal Housing and Finance Administration, the group that runs Fannie Mae, and they are reporting that the debt-to-income ratio is now approaching close to 40% on the U.S. housing market. In the third quarter of 2022, it was 38.8%, and I'm projecting that today, in the first quarter of 2023, it's 40%. And what this means is that the average home buyer in America's housing market with a mortgage is spending close to 40% of their gross income on their interest in mortgage costs. Now, why that's very concerning is because that's a very high level of mortgage interest debt. It shows that people are very stretched. And in fact, it's a higher level of interest burden than people had in the run-up to the last bubble. When the debt-to-income ratios in 2004 and 2005, they registered around 37% and peaked at 39% in 2007. So I want...
Okay, here's where he's cherry picking some data and just probably doesn't have the experience to understand why it is the way it is. This data isn't necessarily telling you what he thinks it's telling you. So yes, it looks like the debt to income ratio for buying a house now is higher than it was then. There's a couple key issues about that. One is the debt to income ratio now is on 30-year loans at a high interest rate that is about to go down in the next couple of years. I expect we'll see interest rates fall down. So there is help on the horizon. You go back to 05 and 06, and this is something that I don't think he realizes. He probably wasn't in the market at that time. We had something called, the subprime mortgage was called liar loans, where you could say whatever your income was. So basically what you would do is you go and say, I want to buy this house. Well, how much do you make? Well, I make $80,000. Well, you can't buy this house unless you make $200,000. Oh, but if you tell me you make $200,000, I can put that on the application. You can get the house. And people were doing that. So the debt to income ratio is artificially low here because the incomes reported on the loan applications were artificially high. So if you took everybody who said they made $200,000 who was really making $80,000, I knew several of those in the Southern California area. There was just scads of them. It's what led to the crash. So instead of being a 39% debt to income ratio, they were probably closer to 45 or 50% debt to income ratio because these people were lying about their incomes. Now the second thing is, one of the natures of those loans was that you could make a payment that was actually below your monthly interest payment. And in fact, the principal of the mortgage went up every month, and people were willing to do this because the market was going up so much that they figured the appreciation would outstrip what they owed. So now where you've got people in a 30-year fixed mortgage where the effective payment compared to their income is going to go down as their income goes up. Back in 05, 06, you had people paying not even the principal, I'm sorry, not even the interest on their loan, and those loans reset. They hit a point where you could no longer make the quote unquote minimum payment and you had to roll into a 30-year amortized or a interest only. And in some cases, that was a 50 to 100% increase in the monthly loan payment. So you look at this debt to income ratio, it's artificially low because people were lying about their incomes. Their incomes were a lot lower than they were, and they were making a minimum payment that was about to go up 50 to 100%. That makes the debt to income ratio in reality much higher back before the bubble than it is now.
I want you folks to think about this. The mid-2000s was known for all the bad mortgages that people took out that people couldn't afford. Yet, the debt-to-income ratios back then are comparable to what home buyers are buying at today, which suggests that we are going to see mortgage defaults and foreclosures in this housing cycle. There's lots of people who like to think that we're not going to see those. They say that we don't have bad loans anymore. They say we don't have subprime loans, and thus there won't be foreclosures. But how could that be the case if the debt-to-income ratios today are the same as they were in the mid-2000s, while the down payment levels today, they're actually lower than they were in the mid-2000s?
Okay, this is another interesting point to make because it looks like he is able to show that down payments were much larger back then. He's also, if you remember back, he said, we have a lot of bad loans. We don't have a lot of bad loans. Most of our loans out there are 30-year fixed. The debt to income ratios are maybe higher than he would like to see, but the loans themselves aren't bad. Bad loans are loans that are giving under faulty premises. You've lied about your income. You are making less than the full payment. Those are bad loans. Loans where somebody's stretching to buy their family a house and it's an owner-occupied loan where you're living, people are much less likely to walk away from that and much more likely to find a way to make it work. Now, the reason that the average down payment was higher back then was because people were able to refi every 6 months, pull money out, and buy investment properties. Investment properties required 25% down. You couldn't get 0% down on an investment property like you could on a primary residence. So people were running a primary residence with 0% down, refining it and buying investment properties at 25% down and then refining those every 6 months and buying more. I had one guy who came out and he showed me a spreadsheet and he's like, hey, if the market keeps going up in 10 years, I'm going to be richer than Bill Gates. I was like, yeah, but if the market keeps going up at 20%, in 10 years, your $300,000 condo is going to be worth $2 million, and that's not going to happen. Just complete blinders on the market. The loans were bad. They are not at all in the same classification today as they were then. And to say that they are based on down payment and debt to income ratios that you don't understand is a big mistake.
People put more money down, around 22%, on their home purchases in 2006, according to the Federal Housing and Finance Administration, than they are today. Which means that we will see a wave of inventory and forced selling on the U.S. housing market at some point in the future. I can't tell you exactly when that's.
Okay, he's also failing to draw the line. Let's say he's correct in his assumptions, which he's not. He's saying these will cause this. But he's not showing you how he gets from here to here. You've got to have a reason. If my mortgage is 40% of my income and I've got 30 to 40% equity, you've got to show a reason why, because that payment is high, I'm going to let my home go into foreclosure and lose my 30 to 40% equity. You don't just get there by saying, because a long time ago, when people had nothing down, no equity, and their mortgages doubled, they walked away from their houses, is not the same as I got 30 to 40% equity, my mortgage is staying the same while my income goes up. The risk is if people lose their incomes, and then yes, you will have some houses sell, but it's not going to be a rush. Not everybody's going to lose their job at the same time. Not everybody has no savings where they're going to have to put the house on the market in the first month they lose a job. There are going to be other options. You can rent rooms out. You can borrow from family and friends. And people will try this. And while they're trying this, homes will slowly come on the market. But demand is still much higher than supply, so those homes will easily be absorbed. It is not a wave of homes coming on the market just because he thinks the debt to income ratio is off when he's comparing it to what was a very faulty number.
Going to be, which I know is frustrating for a lot of you home buyers out there who've been waiting 1, 2, maybe 3 years to buy a house. Some of you are at your wit's end and don't want to wait anymore, which is understandable. However, it's my job to inform you guys that it's still a very risky proposition to buy a house today with how overvalued the housing market is and how many, let's just say, stretched out mortgage holders and mortgage borrowers there are. And these factors are now intersecting with a massive collapse in home buyer demand. The mortgage purchase application, the home sales, they're close to the lowest level in 2 decades. With CNBC reporting that June home sales just dropped to their lowest pace in 14 years as short supply chokes the market. June home sales were 19% lower than they were last year, the slowest pace since June 2009. And so very important that you guys understand this point, whether you're a buyer or an investor, is that the demand in the market is still at rock bottom levels. Home buyers.
Okay, this is just insane. He just showed you an article saying that sales are down due to lack of homes for sale. And then he says it's very important that you realize that demand is at rock bottom levels. All the articles he just showed you had to do with supply, nothing with demand. Demand is still strong. We're selling houses here very quickly. Last house I sold had 15 offers. One condo on the market right now, first open house today, I'm expecting 5 offers. So demand is still there. It's going to be different in other areas, but to show an article that says home sales are low because of supply and then try and say you've got to understand the demand is at rock bottom, those aren't even, I don't know how I got there. That's just delusional.
They are out on the housing market. They don't want to buy. They know prices are too high, especially with mortgage rates now hovering around 7%. The affordability metrics just make it not feasible for the vast majority of people to purchase a home. And just how bad is this situation? Well, according to the National Association of Realtors, seasonally adjusted home sales were 4.16 million in June. Now you can see that's way down from the home sales and buyer demand we had during the pandemic. And you can see this yellow dotted line. Yes, it's legitimately at the lowest level of home buyer demand that we have seen since
That's not home buyer demand. It's home supply is the problem. You could triple the inventory, double the inventory right now and sell it. He's talking about demand being the only factor here. Yes, demand is much lower at 7% than it would be at 3%. But I did a video a couple of months ago on the fact that the elasticity is much stronger for buyers than it is for sellers. And what that means is if you're looking for a home and the interest rates are 7%, when the rates go from 7% to 6.5 to 6, you're going to get another bedroom, a bigger yard, a better neighborhood, a view, a pool. The house you can qualify for is going to dramatically improve when interest rates go from 7 to 6.5 to 6%. However, if you are in a mortgage right now, like most of the country, under 4%, heck, under 3.5%, rates going from 7 to 6.5 to 6 don't do a thing to help you trade up on a house from a 3% mortgage to a 6% mortgage. Rates are going to have to go from 7 to 6 to 5 to 4, and then the inventory will start to free up, and sellers will put their homes on the market strictly because they can then make a move up or at least a lateral move. So the point being, demand is going to surge when rates go from 7 to 6.5 to 6 because of how much more home people are getting, while supply will not. And that is going to cause values to shoot up. And I think he's 100% wrong advising people not to buy a home here. First of all, buy a home when your family needs it. Buy a home when you need to set down roots, not because it's going to make you wealthier or retirement. Do that with your investments. Your home is for your family. Second of all, when interest rates do fall, we are going to see prices rise. So if you are holding on now and thinking that when rates fall, you'll jump in because you can buy more home, watch out, because there's a whole lot of people thinking the same way you are, and they're going to jump at the same time, and prices, you'll have about a 2-month window where you'll be able to do that, and then prices are going to go through the roof.
The start of the 2007-2008 crash. There's a big, let's just call it, disagreement in the real estate industry about why home buyer demand is so low right now. People who are bullish on the housing market, people who work for the National Association of Realtors and Redfin, they claim that buyer demand is low because inventory is low. For instance, Lawrence Yun, the chief economist for Realtors, said that there are simply not enough homes for sale. The market can easily absorb a doubling of inventory, is what he says. He says that listings and inventory doubles, there'll be the buyers there to absorb it. But I disagree with Lawrence Yun. I think the reason buyer demand is so low is because the affordability metrics are so poor on the U.S. housing market. Think back to those.
You're missing the point completely. Lawrence Yun isn't saying demand is low because buyer. He's just not saying demand is low. He's saying we have enough demand for double the inventory. And agents on the street will tell you the same thing. The demand is there. You are creating a false narrative that we have low demand. Just the fact people are watching these videos says there's high demand. People watching these videos are desperate to buy a house. They want to buy a house. They are the demand side of the equation. The supply side is the problem. And he's just missing that up every step of this video.
Those graphs I showed you in the beginning of this video, the housing market's 30% overvalued compared to incomes and rents. And when you factor in 7% mortgage rates, well, most home buyers just have no hope of buying a house.
Okay, now he's adding affordability and then saying interest rates make it worse. No, interest rates are why there's affordability problem. So it's not a double problem. It's interest rates are high. When interest rates come down, you're going to see a flood of people diving into the market.
Especially in a state like Florida, where the house payment as a percentage of median income is now 45%. In Florida, the median household makes $66,000. They would have to spend $30,000 a year on their mortgage, interest, property taxes, and insurance in today's market. Or let's.
Okay, now you're just ignoring Florida as the demographics of Florida. People move to Florida to retire. You've got a lot of retirees there. So their income is their Social Security. Just because somebody only makes, say, $30,000, $25,000 on Social Security doesn't mean they don't have $3 million in stocks and bonds, and they've got a mortgage on a $300,000 house because their interest rate's 4%, and they can put their savings in a 5% muni bond that's tax-free and make more. That's just a stupid point. Basically, people in Florida have lower incomes because they have much higher savings because they're retirees.
Zoom on over to California, where the typical house payment is 62% of the median household income. I mean, very clearly, especially in these states in red, the homebuyer affordability is so bad that even when inventory increases, there won't be the buyers there to.
Okay, here's another point. He's pointed out affordability nationwide at, I think it was like 40% of income going towards a house. Yet he's showing states, Colorado where it's 45%, California where it's over 60%, and we're not seeing foreclosures there. So if California's at 60%, we're not seeing a rash of foreclosures. Why are you predicting that with the rest of the country at 40%, we're about to see a rash of foreclosures? Your own evidence you're showing is shooting a hole in your case.
Backfill the demand because they just can't afford it. And just to see, let's just take a look at Montana. Today's home buyers in Montana need to spend 52% of their income on a house to afford it. Previously, historically, that was 28%. The last bubble was only 32%. So we're at an unprecedented level with how bad affordability is. And until that affordability conundrum gets solved through the way of both lower home prices and lower mortgage rates, we will not see a meaningful recovery in buyer demand. Which is a.
We don't need a meaningful recovery in buyer demand. We have buyer demand. What you're going to see when he says you need to see both prices fall and mortgage rates fall. Well, those of you on the sideline who are buyers, you can figure this out yourself real quickly. You're telling yourself, hey, when rates go down, I'm going to buy. Yes, so is everybody else. So when rates fall, we're not going to see values fall because you're going to have a lot more buyers, and that's going to push values up. He's just missing the point here.
Big problem for a lot of people in the housing market, particularly realtors. I know I have a lot of realtors that watch this channel, and I know that some of you are struggling right now. I mean, these very low levels of home sales combined with the beginning of price declines have really cut into how much money realtors make. With the number of single-family home sales per realtor only registering 2.3 per year right now. That's basically the lowest level of sales activity per realtor of all time. And because of this reduced sales activity, we are now seeing realtors quit. I first reported on this about a month or two ago, and since then, we've continued to see realtors drop out of the market, with realtor growth now falling to minus 1.1% year over year. So we're now about 3 or 4 months into declining levels of realtors year over year. You could see that it was around the same time in late 07 that we started to see this decline in the last crash, as well as in the early 1990s during that last housing downturn is when the realtors started to quit. And to me, this is a big leading indicator that's telling you where the housing market is heading, and it underscores the fact that housing downturns happen slowly. And if
Okay, so he got one thing right here. The housing market for realtors, lenders, appraisers, it sucks, okay? But the number of realtors saying that's a leading indicator, I don't think leading indicator means what he thinks it means. Leading indicator means when you're losing realtors, you're going to see a crash. No. Losing the number of realtors is a reaction to what has happened in the past and is happening now, which is the number of transactions is falling. So if you lose 50% of your transactions, you can't have the same number of realtors putting food on their table at half the transactions. So you lose realtors. It is in no way a reflection of what's going to happen forward. Look at this. I don't want to shame my industry or slam my industry, but realtors aren't the brightest people in the world. They're not predicting that 6 months from now the world's going to get better, so I'm going to go from flipping burgers at McDonald's and get my real estate license, get into the business to catch the wave. No, people don't get into the business because they are able to economically figure out that 6 months from now it's going to be better. They get in the business when it's good and they see everybody else making money, and then when they can't make a living, they get out. It is in no way a leading indicator. It is a lagging response to what has happened.
If you're a home buyer and investor wanting to understand the housing market, you have to understand this point. The housing market does not act like the stock market. You will not see prices drop 30 or 40% in a year or 6 months. It will take significant amounts of time for both home sellers and realtors and a lot of it legacy investors to accept the fact that the market has entered a downturn. And historically, on average, a housing downturn takes 5 years from start to finish. Whether you look at the downturn from 2007 to 2012 or the one that occurred in the early 1990s in different regional markets in America. And that fact and reality, I think, is uncomfortable for a lot of people because it suggests that we're not going to see immediate relief. We're not going to see all of a sudden tomorrow for you as a home buyer, it's just not going to get like way better to buy a house. It's going to be an incremental process, which you can understand if you look at maybe this listing on Zillow. Now, this listing is in Nashville where there's lots of
Okay, before we get into this listing on Zillow, he's right. Downturns take about 5 years. This isn't a downturn. We had a correction. Starting in May, June of last year, so a little over a year ago, the market fell, depending on where you are, 5 to 15%. Now, depending on where you are, the market is back within 1 to 2% of where it was. So what's frustrating here is not that people aren't realizing that this correction or crash is going to be 4 or 5 years unfolding. It's that people who called the crash have seen a recovery and now are desperate to try and explain it, kind of like he is doing.
Inventory on the market right now. It's on the market today for $975,000. Still a high price, but you can see originally it was listed in March for $1.4 million. This was actually a flip. They've just been incrementally cutting the price more and more. And the price is still high, but the point is, if a seller has an idea of what the value of their house is, whether it's $1.4 million from the start or whether it's $900,000 from the start.
Okay, this was deceptive. You guys can go back in his video and you can see the address on that listing, which is exactly what I did. And I looked the house up. So he's telling you that They've had price drops from 1.4 million to 975 or 925. What he's not telling you is the flippers who flipped it and put 100 or 150,000 into it bought it a year ago for $520,000. So at 925, 975, heck, at 750, they're still making a killing. The problem isn't here that the market's going down and they're losing money. The problem is here is that they didn't have any idea what the market was doing and priced the house way over. Now, if they had bought it for $1 million, did work, were selling it for $1.4 million, had to drop between 950, he'd have a point. But he's being dishonest here because he didn't show you that the people who are trying to sell it now in the 900s bought it for 540, and that creates a completely different picture than what he's leading you to believe, that they're getting screwed and that they're losing money. They're not losing money. They're doing fine. The market's still strong.
Sorry, they're not just in a month or two going to cut it by 30 or 40%. It's going to be an incremental process. That house might have to be on the market for over a year before the seller's finally going to wake up step by step to the price that it should actually be to sell. And we have quite a few housing markets in America right now that are going through these fairly large price cuts and where prices are going down. The way to track these housing markets to understand where prices are going down is to go to Reventure app and go to a metric called price cut share. This tracks the percentage of sellers cutting the price and which states have the most price cuts. Well, you can see.
Okay, God, this is amazing. This stat he's showing it sounds like its prices are falling, but its price is being cut. It doesn't tell you whether the price it's being cut to is higher or lower than the market was last month. Basically, what has happened is sellers have overpriced their homes because they've gotten greedy, and now they're having to lower the prices. But these prices, let's look at what his first price cut share is.
In red, Texas has a lot of price cuts. Colorado,
so
Utah.
Colorado, he's got Utah up here. It says 27% of the homes had a price cut. That's not unusual given the fact that sellers tend to be greedy and overprice the house. I've sold hundreds of houses in my 20-year career, and I can guarantee you that there's only about 10 times when I've walked into somebody's kitchen and they actually thought their house was worth what it is or less. Everybody always thinks their house is worth more than it is. And what you're seeing here is real estate agents are so desperate for a transaction, for a listing, that they are not arguing the price. They're just telling the seller, fine, you want to put it on for $1 million when it's worth 800, let's do it, we'll try it, knowing full well that as long as they get a 6-month contract, that price will come down. So what you have is you've got a lot of agents out there who are reluctant to tell the seller what it's really worth because they do not want to lose the business, and therefore homes are going on the market at too high a price, and price cuts are coming to those homes. When I walk in with somebody, they listen to the numbers, they see it, they go, yeah, I really wanted $1 million, but now I see it's only worth 900. We price it 900, we sell it. If they're going to price it $1 million, it's going to sit. And that's what's happening here.
Idaho, they're towards the top. Interestingly, Indiana is number 1 in terms of the share of sellers cutting the price. But let's get even more granular and look at all the different metro areas in terms of price cut percentage. If we just filter to metros above 250,000 in population, we can see the ones with the biggest price cuts are Austin, where 46% of sellers reduced the price. Most recent month, we also have Colorado Springs, Fort Wayne, Indiana, Evansville, Indiana, Huntsville, Alabama. This is an interesting one.
Okay, now I want to step back a little bit and say, I am not saying that in some areas prices are not falling. Yes, in some areas prices are falling, and these cuts are very severe. But a lot of these cuts, remember, price cuts are not sales price. You can't look at a home that had, or an area that has a 46% price cut, and maybe they're cutting it $5,000 at a time. Maybe they're cutting it $50,000 at a time. Maybe they're 10% above where they were last year. Maybe they're 10% below. This price cut number does not give you value or change of value. It gives you change in asking price. Okay. Now, some of these areas I'm sure are definitely going down. I'm saying as a national whole, we are not seeing a crash, and the data he's giving you is misleading and inaccurate to try and make you think that we are or will be.
Huntsville seems to be on the decline now. Waco, Texas, Ogden, Utah, Mobile, Alabama, South Bend, and Denver. But it's not just price cuts, everyone, that's going to tell you the market's going to go down. It's also price cuts in combination with higher inventory and higher days on the market. Those three things really will tell you the direction of your housing market into the future, and they're all available on Reventure app. And one thing I like to do is actually filter and find the cities that have the most price cuts, the most inventory, and the highest days on the market. We can do here through the filters tab. Let's filter price cuts above 20%. Let's filter inventory growth above 20%. And let's add days on the market growth also above 20%. What do you notice? Okay, what's left here? Well, these would...
Okay. Probably heard the phrase lies, lies, and damn statistics. That's what we're looking at here. Yes, you're seeing price reductions in some areas. However, rises in inventory and lengthening of times on the market, you're going from record low levels of inventory and increasing 20%. You're still 50% below normal. A lot of these guys play this game with foreclosures. They say foreclosures are exploding. They're up 30% in the last quarter. Well, yeah, but there was a foreclosure moratorium during COVID and we essentially had zero. So maybe you had one or two foreclosures that stuck through and now you're up 30%. A percentage increase is not real meaningful unless you know where you started from. And all these numbers he's quoting started from record low levels of inventory, record low time on the market, and it's increasing. It has to increase. It's just normal. It's not a fire. This market is not burning down.
B, the housing markets that are most likely to see price declines over the next several months. They're almost all predominantly in Texas, Florida, and certain parts of the Southeast. Now, we can also conduct the reverse analysis to see which markets are least likely to see price declines over the next 6 months. They would be the ones with the fewest price cuts, the lowest inventory growth, and the lowest days on the market. What do we got now? Well, now it's the reverse. We've kicked out all of these markets in the Southeast, and now we're focusing mainly here on the Northeast. We have some Northeast markets where they're still very, very tight. Prices will still likely go up or stay flat for the rest of the year, also in the Midwest and Chicago. Also, we're seeing some interesting things happen here in California, in markets like Sacramento, Stockton, San Jose, and Visalia, where these markets have turned a lot in the last 6 months, and they're starting to favor sellers more than buyers. And that's due to, again, the decline in inventory. There's been a big drop in inventory in California over the last year. In a market like San Diego in particular, inventory is down 35% year over year, and that's now causing the California downturn, which was the hardest hit market, to stabilize. And I know this has been a frustrating thing for a lot of you home buyers in California. You're wondering, well, with prices and mortgage rates still so high, how is it that I'm not seeing better deals out there? And it's because of a lack of new listings. And unfortunately, in California and other cities around America, it's going to take some of these sellers being forced to sell through mortgage defaults and liquidity needs and things like that to return new listings to the market and push inventory up and prices.
Once again, I don't see how you go from high payments when somebody bought a house that they put 20% down, 15-20% down, so they've got that equity, and the market's gone up, so now they got 30 to 40% equity. He never draws a line from how you get from somebody with 30 to 40% equity who has a high payment that's fixed for 30 years, it's not going to go up again. How you get that person to sell their house, he's missing all the steps that get me from, oh, my payment's high, but I've got a ton of equity, to I'm panicking, my house is being foreclosed on, or I've got to sell and all my neighbors are selling at the same time. I don't see how you get from one to the other. There's not even a windy road that'll get you from one to the other.
Is down. But some people are now convinced that that's not going to happen. Some people keep saying things like, we're never going to see inventory increase because all these home buyers have 3% mortgages that they've locked in and will never sell. You can let me know in the comments if you've heard someone say that or you think that yourself. And
gee, where have I heard someone say that?
I actually polled you guys here on YouTube and I asked you the question, What percentage of America's 97 million houses have a mortgage rate less than 3%? Now, 29% of you said 15% of houses have a mortgage rate less than 3%. 29% of you said 30%, 18% said 50, and 24% said 65. So a quarter of you think that 2/3 of houses in America have a mortgage rate less than 3%. And folks, yeah, if 2/3 of homeowners in America have a mortgage rate less than 3%, well then we will never see inventory increase. I would agree with that. But what's the actual number? How many homeowners in America have a mortgage rate less than 3%? Well, data from the Federal Housing and Finance Administration shows that 23% of mortgage holders in 2023 have a sub 3% rate. So that's 23% of mortgage holders. But remember, many homeowners in America don't have a mortgage. In fact, of the 97 million owner housing units in America, 37 million have no mortgage, or 38%. So that means that for those who have a sub 3% mortgage rate, it's 14% of all housing units. 14% have a sub 3% mortgage rate, which is a lot. It's good for some of you out there who...
Let's go back here. Let's look at this. 14% have a sub 3% rate, which is actually lower than I thought. And 38.7% have no mortgage. And I'm going to contend that 3% is not the key. When rates are at 7, nobody's selling until rates get below 5, right? That's just too big a difference in payment and too much less house they get. So let's not even look at 5. Let's look at people below 4. So we've got 38.7% with no mortgage, 14.3% with a sub 3%. That right there gives us 53% of the market. Add in 23% that are below 4, and you're at 76% of the market. 3/4 of the market has either a 4% interest rate, a sub 3 rate, or no mortgage at all. How are you gonna... this guy's driving me nuts.
Units. 14% have a sub 3% mortgage rate, which is a lot. It's good for some of you out there who have that low mortgage rate, but you can obviously see through the data that 14% of mortgage holders having a sub 3% mortgage rate is not what is keeping inventory off the housing market. There's another 85% of homes that have no mortgage or mortgage above 3% or that are vacant that could hit the market. And the reason they're not hitting the market is because the owners don't feel the stress to sell. That is the biggest reason why new listings...
People don't just sell houses because they have a stress to sell. They sell for opportunity, better life for their family, better place to live, moving out of state. It's not always stress. This isn't driven by fear all the time. And saying that people, 80% of the market doesn't feel the fear that they're going to need and the stress to sell, well, they don't have the opportunity to move up either. You're not going to go, reward your family for doing such a great job and being such great people to take them from a 4-bedroom to a 3-bedroom house. It's just not going to happen. And when you see 75% of the people, well, it was like, 50% of the people have a mortgage between 4 or lower, and then we've got another 25%, I think, that have no mortgage. That 50% of the people aren't going anywhere till rates get down at least below 5. And that's just a fact of life. And it's not fear, it's lack of opportunity.
Things in inventory are low. The unemployment rate's 3.6%. The U.S. government has piled trillions and trillions of dollars into the economy over the last 3 years. They suppressed interest rates for a decade. They built an expectation that nothing bad will ever happen in the housing market again, and if it does, the government will be there to rescue it. That is why new listings are low. On top of that, there's also concern now about the banking sector in America. I just had one of you email me and say that they have their money in a small bank in Florida. They're looking to buy in Harrisburg, Pennsylvania, and they think that there will be a decline in value, but they actually would prefer to take the hit in value on real estate than leaving their cash in the bank. And so I wonder how many people would have sold their house this year, but didn't sell their house because they didn't want to get a windfall of cash that they would leave in the bank at a point in time when the banking sector in America looks perilous. I think that could potentially be an additional explanation for why inventory and new listings have been low this year. Ultimately, everyone, let's bring things from theory back to reality. What are, my projections for the housing market for the rest of the year, and what should you do as either a home buyer, investor, or realtor to ride out this storm? Well, if you're a home buyer, you have to understand that home prices are still tremendously overvalued. And that's not my opinion, that's a fact. In particular,
that is not a fact, and I think I've shown why it's not a fact. It's driven by an inaccurate reading of statistics. Now, I want to give you something else that I have found with the buyers I'm working with, is some of them are not in the market right now because of the stock market. Let me explain. And I am in Southern California, a lot of our buyers are tech workers, and therefore they are tech investors, and therefore their stocks have done very well this year. A lot of people who say they do not want to buy a house this year because they do not want to pay the capital gains tax of liquidating their stocks. But come January, they can sell their stocks on January 1, get another 1 year before they have to pay the taxes, and those people jump in. That's not going to be a major factor. That's really minor, but it's going to be an uptick in the higher end of the market.
The ratio of home price to income in America is near a record high today. It's 31% overvalued compared to its historical norms. The same thing for home prices to rent, and the same thing for home prices adjusted for inflation. What that means is that there's a very high likelihood that prices go down in the future because we've never been able to sustain these levels of prices in the U.S. housing market.
You're not going to sustain these levels, and it's not prices, it's monthly payment that this is measuring. It's not house value versus loan, it is monthly payment versus income. Monthly payments will go down when rates go down, and they'll go down dramatically. Income will go up as we get inflation. That'll be less dramatic, but if we see inflation keep going on at 5% a year, salaries will start going up 4, 5, 6% a year. That will change the ratio. So the ratio will change. It's going to change the fastest when the rates get cut from 7 to 6 to 5%. That completely takes out all the overpricing overnight. Rates go from 7 to 5%, all of a sudden that is going to go back to historical levels, and this market is going to take off like a bat out of hell.
Before. Now, those declines might take more time to hit than some people expect. During the beginning of the last downturn in 2006, 2007, prices basically traded sideways for a year and a half before they really started to drop in the middle of 2008 when the economy started to tank. So what you have to do as a home buyer is decide what your risk tolerance is, how much cushion financially you have to absorb losses, and if frankly you can afford to buy a house right now at today's mortgage rates and prices. Now, if you're an investor, you just have to understand that this is a challenging environment to be an investor. Cap rates are still fairly low. Interest rates are high, meaning that the opportunity cost of capital says it's better to invest in a treasury than...
So, a couple things here. If you're an individual buyer, if you can handle the monthly payment on your existing income and you have a nest egg and your family's been renting and been evicted when the owner's going to sell and you're just tired of living that lifestyle, yes, now's the time to buy. Because with the rates at 7%, the odds are the rates are going to go down. If you buy as much house as you can now without putting your family under a huge financial stress, over the next 3 years, your income will go up, mortgage rates will go down, your payment will go down, and you will build a ton of equity in your home. I think this is a great time if you can afford something. Now, in terms of investors, yes, I've always said that I didn't want to invest in San Diego. I wanted to invest out of state because cash flow is terrible. Full disclosure, my wife and I bought a duplex in San Diego about a month and a half ago. Our reasoning there is California has new ADU rules, and we are going to be able to put a lot more units on that property. In fact, we've done a YouTube playlist just on going through this process of how we evaluate it and what's going on, and you can follow that. But investors have money, they're on the sidelines, and they're bidding on properties. And as soon as there's any sight that this is going to go down, they're going to jump in, because everybody who's been in real estate for any length of time knows that when rates go down, prices go up. Therefore, If this is the peak of the interest rates, you've got a lot of investors with a lot of dry powder. They're going to throw it because just with rates going from 7 to 4%, they are going to make a killing. And that alone will keep the market from falling. In doing my edits, I decided to stop the video here because the rest of his video basically is advice to realtors on how to survive and pitching a future video he is doing on the unemployment rate. So I also realized that my tone was fairly harsh with this gentleman, but it was my honest reaction. He has a lot of subscribers, over 400,000, and most people who are going to subscribe to him are subscribing because his message appeals to them, and his message has been the housing market is crashing. You will be able to buy a house when it does crash. Just wait. Now he's moved into the point of, gee, it kind of crashed and then it recovered, but I wasn't wrong, it's still going to crash again. And none of the data he's providing supports that if you look at it. And I don't know, I'm going to assume it's ignorance because he wasn't really active in the last crash. He doesn't know what was driving some of those statistics. And let's just give him the benefit of the doubt. But I also realize he's motivated to keep that message going because that keeps his subscribers synced with him and keeps his income going. So if you are one of those people who's relying on the future crash of the market, I hope that I showed you why that might be a mistake and you should probably take some different action. If you watched the whole video, I really appreciate it. I know it was long. And until next time, make it a great day.